This is Daybreak Asia. We're counting down to Asia's major market opens. And Heidi, I don't want to discount Korea today, but my focus is very much on what's happening in Japan because we've been tracking that rapid ascent in the Nikkei 225 and today looking to pass that key 40,000 mark. Futures very much indicating that that's going to be happening.
And I'm sure lots of investors in South Korean equities will be looking keenly at this, hoping that this is a trajectory that, you know, the unlocking of value in Korea follows as well. But of course, we're also watching developments when it comes to what's going on in Beijing with the political pageantry and also, of course, the twin sessions, CPPCC and MPC taking place. But 40,000.
Yeah, certainly that level we're going to be watching closely here. You've got the open for Japan, and as we said, that Nikkei 225, taking a look at the level that we've got today, within a whisker, or rather just passing that 40,000 mark. So that's a key psychological level that we've been tracking here, really defying concerns for investors because we've seen that big ascent, that advance from the 1989 peak from last month, and then onward, of course, past that 40,000 mark, defying those concerns, as we say, investors thinking perhaps the gains have been too rapid. You've got that RSI hitting above 80 at this point in time, but it's been above 70 for almost 3 weeks now. So certainly in overbought territory, perhaps just from that indicator, but still we're above that 40,000 mark for the first time. So very much a raising and taking us all the way back to the levels that we're at, as we said, the early 90s when they had that bubble bursting. So Japan, those gains that you're seeing here in the session today, you've got the Nikkei up around 0.8%, and broadly we're going to be watching that one. The Japanese yen there still continuing to hold around the 150 mark, and we know that yen weakness, again, has been one of the factors that's been really supporting Japanese equities given the large number of exporters. Some data to note, we just had company profits. They were up around 13% on the year. Sales as well increasing, so just another positive indicator lending into to Japanese equities. But let's change on, not to forget Korea, of course, because, yes, as you said, Heidi, Japan, that focus on corporate governance reform, Korea wants some of the same because they're also getting really focused on that as well, and we are seeing the Kospi here continuing its gains, and the Korean won a little bit firmer as well. So just a signal of that level of risk tolerance that we have in markets right now. But let's bring in Christy Tan. She's APAC investment strategist at Franklin Templeton Institute. And Christy, I'm interested for your views here. As we say, the Nikkei 225 breaching the key 40,000 mark for the first time ever. What do you think about the gains we've seen so far? Are you concerned, as we say, that it's been too far, too fast?
It is amazing how Japan actually went from the most unloved and now I think one of the most loved equity indexes across globally and of course, Asia Pacific. And I think this has to do with a lot of the positive developments that has happened and keeps happening. And we saw how, you know, profit levels of Japanese companies have been on the up and going from strength to strength as well. And manufacturing activities are also more upbeat. And at the same time, I think if you look at some of the developments that has started to manifest, and this includes the increase in wages, the corporate reforms development, and also I think sustainable inflation that could support the overall policy change or policy shift from a negative interest rate policy and to normalization. I think these are continuing supportive factors for the Japanese equity markets. Now, at the same time, I think if you look at externally, right, so there is also the relative unattractiveness of, for instance, the Chinese markets. And also, I think there is that flows of investments funds that are looking for opportunities across the space. And this fear of missing out, given the irrational exuberance in the U.S. equity markets, is probably widening across to the Asia-Pacific region.
Yeah, and how long do you think that would sort of persist? I'm curious as well, when you take a look at the inflation outlook, we just had local media in Japan saying that Japan could consider calling an end to deflation. That could also factor, of course, into the BOJ's thinking. So how do you think central bank policy shifts are likely to play into that market dynamic?
Absolutely. So we're definitely looking at a potential shift, and this is going to be, again, a structural possibility. So in that case, timing is of course a big issue, but I think, sometime in this year, and this is largely within a lot of investment analyst expectations that, the BOJ will at some point this year actually shift towards removing the negative interest rate policy. And what is then important is that whether or not this is priced in. And from what we have seen across the equities complex in Japan, possibly 40,000 being breached for the first time and potentially going from strength to strength is still a possibility, especially when we see that the policy shift and the BOJ actually signaling that has already started to happen, and later part of this year is definitely a possibility for that.
Christy, it's interesting because if you take a look at what's driving this rally, the momentum factor for Japan has just been getting stronger and stronger, right? This winning strategy of buying stocks that are doing well. Are we starting to look at a more polarized market, though? Because there is starting to be this pretty big gap when it comes to stocks that have rallied, continue to rally, and underperformers are really starting to lag.
We are definitely looking at that, not just within Japan itself, but across the region. And if you look at how India, Vietnam, and also now Japan, these have shown that relative strength that APAC and the attractiveness of emerging markets versus perhaps, some of the opportunities in the developed markets. So going ahead, this divergence is a reflection of how the market sentiments are placing out, and with regards to the U.S., where there is narrow leadership. I think in the U.S. there is the Magnificent Seven, and in Japan, increasingly, investors are actually talking about the Samurai Seven. So there is also that momentum that is still continuing to build up across Asia-Pacific region. And we're seeing investment opportunities, and this is from the survey that we are doing across our Franklin Templeton complex. And we've actually surveyed, and we've received survey results from 300 of the investment professionals within the company that shows that going ahead, well, we are expecting that, some of this narrow leadership to broaden out, and as well as not just in terms of equities, given where we think the Fed policy and the rate cuts will be and will happen. So this we do expect global growth to be slower than consensus across all major regions, but at the same time, recessions will be avoided, and inflation in the U.S. will continue to moderate. So some of these factors are actually driving investment flows potentially to fixed income.
Christy, we're watching South Korea very closely because obviously regulators there want that market, the reforms to follow the trajectory that we've seen for Japan. But the response from investors to the corporate value up program has been lackluster. Do you see South Korea being able to replicate, insofar as it's taken over a decade for Japan, this level of success?
Well, there are opportunities within South Korea that are also very I would say that prioritized within the tech space and the technology space. And this continues to be, I think, a key support and pillar for the South Korea investments and opportunities and also asset classes. But at the same time, I think you're right in mentioning that, the gap between Korea and Japan could be widening and could get wider. I think this has to do a lot with also the challenges that South Korea is facing, and I think with the U.S. elections that's happening this year, there's going to be a lot of that geopolitics concerns that will also drive a lot of selectivity in terms of whether or not Korea will actually outperform in this case. And with what's happening across the headlines, of course, that with the situation within the medical profession, that is also manifesting. I think that is going to be a drag on sentiment somewhat, but we don't expect any kind of a structural, I think, negativity that will actually affect South Korean assets significantly. I think there is still a lot of that tech possibilities and potentially, I think, the continued maneuvering of the South Korean tech companies towards the tech sector will be a key driver that will support Korean assets.
And Christy, I've got to get your sort of assessment when it comes to where we go from now from China. What are investors, you think, keen to hear from the leadership this week as we kick off the two sessions? Is there anything that can really try and consolidate a bit more confidence, including that GDP target?
Well, China is definitely at a juncture where the policy authorities will have to send the right communication messages across, and I think they will. I think the base case is that these MPC and the two sessions that is happening this week and will probably end by the middle of this month will see that the baseline growth of around 5% target, and also at the same time to achieve that, I think that not only shows the conviction of Chinese authorities to maintain that growth policy, but at the same time, there will have to be more growth supportive policy and measures that will have to be implemented. So I think that in its case is a vote of confidence for investors that the Chinese authorities will do more. And we're starting to see that already happening since January. And so the pivot the policy pivot that we are expecting, and I think markets are looking for that, around 5% growth target, around a 3% inflation expectations, and also at the same time, more fiscal policy measures that will support the overall growth momentum. I think that will be in place. And what markets will then, or investors will then look out for is that these policies actually get implemented, more supportive fiscal and monetary policy directions. That has to be communicated, and we think that will be. And at the same time, I think if you look at then, the kind of fiscal spending that needs for this growth targets to materialize, is probably around 3 to 4 trillion yuan worth of policy measures that will be in place.
Christy Tan, thanks very much for your time this morning. That was the APAC investment strategist at Franklin Templeton Institute. And as we were just mentioning there, China is set to announce its 2024 growth target and outline its strategy for supporting the slowing economy at the country's top annual political gathering this week. Our chief North Asia correspondent Stephen Engel joins us live from Beijing. And we heard there, we know it's going to be around that 5%, perhaps, Steve, but still it means that we're going to need to see a lot more supportive policies coming through.
Yeah, are we going to see a lot of supportive policies coming through? I think they're going to talk a good game, obviously, over the next 10 days or so of the National People's Congress, which begins tomorrow, runs probably through about the 11th. We don't have the final date yet. But of course, today also is the CPPCC, which is the advisory body to the National People's Congress, colloquially known as Lianghui, the two sessions. That's why we're out here previewing this, because, again, as the last guest just rightfully said, it's the world really, and investors are looking at China to see what kind of forceful measures might come out of this two sessions to stimulate and to restore confidence. And I agree with the guest who said implementation will be key as well. But so far, Xi Jinping and the collective leadership in Beijing has avoided the big bazooka approach. Yes, we've had some, the national team come in and support the stock market when it was wobbling at the beginning part of this year. February was a fairly decent month for equities here in China because of the state support. And also the property market. We saw banks, essentially cut the loan prime rate, the 5-year tied to mortgages. So that was a good step. But collectively, it's not a big bang. And that's what we're wondering, whether there could be more property measures to support and put a floor on this sinking confidence and, the situation for developers, and also restore confidence confidence in the private sector. It's been absolutely battered, obviously. If you go back to 2020 with Jack Ma and the collapse, of course, of the Ant IPO and then the restructuring of Alibaba. Keep in mind, the private sector in China essentially accounts for about 60% of national GDP and 80% essentially of urban jobs. And that is a key component. You got to keep the young and recent graduates employed, and that's a struggle going forward. So there's a whole list of problems in the Chinese economy right now, and we're looking for signals that they're going to be at least supportive in both fiscal policy, perhaps even more monetary easing, as well as just confidence measures going forward.
Yeah, investors are looking for fiscal expansion, fiscal easing, but at the same time, you've got these heavily indebted provinces, right? What does that mean for, I guess, the discomfort of looking at to try and support the flagging economy versus, what these local governments do?
Yeah, I mean, that's why we're going to be really looking at the work report tomorrow at the beginning of the National People's Congress from the Premier Li Qiang, his marching orders to the provinces. Now, so far, of course, in years past, there would be, in times of economic pain, there would be stimulus going forward in the form of shovel-ready projects at the municipal and provincial level to really stimulate growth in that form on the fiscal side. But again, it's incurred a lot of debt at the local governments, and the local governments are in fiscal distress in many cases, or strain, I should say. I'm not saying that they're necessarily going to default, but again, keep in mind that property troubles in China really exacerbates the fiscal situations at the provincial level, because land sales have fallen off the cliff, and that is a huge part of how they get to refill their coffers. So what we're hearing essentially, that Xi Jinping, he mentioned it 128 times last year, he wants high quality development that is essentially sustainable, and this boom bust cycle of incurring high debt at the local level is not something that he wants to exacerbate further. So they are constrained, and the central government is trying to remain constrained in adding to that debt load. But at the same time, everyone's saying we need something.
Yeah, that's right. Certainly a lot of calls for more stimulus. That was our Bloomberg Chief North Asia correspondent, Stephen Engel, in Beijing there. And stay tuned for the very first edition of Bloomberg's The China Show coming up in the next hour. It's your definitive source for news and analysis on Asia's largest economy. From politics and policy to tech and trends, we'll have in-depth discussions with the newsmakers who matter. The China Show premieres today at 9 a.m. in Hong Kong, Shanghai and Singapore. Plenty more to come on Daybreak Asia. This is Bloomberg.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really it's not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
OPEC Plus is extending its oil supply cutbacks to the middle of the year in a bid to avert a global surplus and shore up prices. Let's get more from our energy and commodities editor, Andrew James. So, Andrew, talk us through what sort of jumped out to you and I guess a difficult environment that this group is facing when it comes to try and predict the market dynamics for this year.
Hi, Heidi. So the cuts, which amount to about 2 million barrels of oil a day, were extended through to the end of June. Pretty much widely expected by the market. A couple of interesting points. First, the Saudis account for about half of that cut. They're under quite a lot of pressure, or self-imposed pressure, to keep the oil price high, given that they need an average price of around $90 a year for this year to balance their budget. Fitch came out with that estimate a few weeks ago, and that's as they build futuristic cities, host sports tournaments, pay top footballers a lot of money. So yeah, they're going to have to sort of work quite hard to try and get the oil price up there to balance the budget. The other interesting point is that Russia, which has been given a special exemption, gets to the exemption allows it to mix production cuts and export cuts with its quotas, and they've said they'll be focusing more on production cuts, which will allow them to keep exporting more to fund their war in Ukraine.
But we haven't exactly seen very good compliance from Russia and some other producers as well. So do you think that we're going to see better compliance moving forward? And how is that likely to play into broader oil markets, especially if we do see those cuts being extended perhaps even longer?
Well, compliance is always an issue. The smaller members have a history of not complying that well. I think the bigger issue for OPEC Plus is that we've got surging production from outside the cartel, from the Americas, particularly the US, but also Brazil and Guyana, and that's. Although oil prices have been on a slow but sort of steady ascent this year, that extra production has really capped the gains. We've also still got a bit of a Middle East war premium in the price. Transport costs have gone up as tankers get diverted away from the Red Sea and the Suez Canal and have to go around Africa. So those are sort of pushing the price up a bit. The surging production from outside OPEC Plus is pushing it down, and also the demand outlook is not looking that great, particularly in China. So all those things mean that it's going to be tough for OPEC Plus to push up prices, and there's a trade-off here because as they keep reducing production and production from other places surges, they're going to lose market share. Well, they already are losing market share, but they're going to lose more market share. So I think that's going to come to more of a head at the next meeting in June, when they decide, what they're doing for the rest of the year. There's going to be pressure from particularly the smaller members who don't want to keep on cutting output, but at the same time you have the Saudis under this sort of self-imposed budgetary pressure.
All right, that was our energy and commodities editor, Andrew James, and we'll have more to come on Daybreak Asia. This is Bloomberg.
Actually, no, I don't have it. The leaders of 9 Southeast Asian nations and Australia are gathering in Melbourne today for a 3-day meeting. Bloomberg's Paul Allen joins us for more. And China looming large, I'd imagine.
Yeah, very much so. And this forum in many respects is about countering China in the region. And I think you can probably put the agenda into a couple of buckets. On the one hand, you've got the economic, and on the other, the strategic. And in terms of the economic side, there's always an interest in growing trade. Taken as a bloc, ASEAN is Australia's second largest trade partner. $178 billion worth of two-way trade there. And there's sort of an opportunity here for Australia to participate in the green energy transition in ASEAN as well. The strategic side of things, perhaps a little bit more nuanced. We've had the Philippines President Ferdinand Marcos Jr. arrive in the country a little bit earlier. Australia and Philippines signed a pact on maritime cooperation, and this is obviously with an eye towards the South China Sea. And Vietnam is also looking to sign a strategic relationship with Australia as well.
And Paul, there's a lot of different countries that are represented, but Myanmar is not going to be one of them.
Yeah, that's right. Myanmar, obviously a very repressive military regime. It's been 3 years since the military seized power there and the short-lived democratic experiment in Myanmar ended. Australia didn't invite Myanmar, but it's going to be represented by the diplomatic embassy staff instead. Some human rights groups are still pretty critical of that. But of course, Australia is not a member of ASEAN, so I can't really dictate that one member can't come. So this is kind of a compromise, really. But this is sort of emblematic of the whole way that ASEAN works. You know, these binary outcomes tend to be avoided. There's a culture of consensus. It's very multipolar and non-aligned in its outlook. And another example of this might be Brunei. Brunei's been operating under a state of emergency for 62 years now, but nobody really talks about that. So that's pretty much how ASEAN tends to function.
All right, Bloomberg's Paul Allen there, and let's take a quick check on how markets are faring so far, about half an hour into the session for Japan and Korean equities. But the headline we're tracking today is the Nikkei 225 breaching the key 40,000 level for the first time ever. Very, very strong momentum that we're seeing in Japanese equities. It is opening the door to further gains in the historic rally, even though when you take a look at RSI, now around the 80 level, also a signal that we are looking pretty overbought. But when markets reach a record, then they tend to be stuck in a range. So something else that we could be tracking as well. South Korea's PMI numbers that have just dropped here. You're seeing for the latest reading, this is the February one, but coming in at 50.7. So the prior survey had shown PMI at 51.2. So we are just seeing it dropping a little bit to 50.7 in the latest reading. But South Korea was shut for a public holiday on Friday, so we didn't actually get those numbers dropping when we saw the rest of the PMI gauges being delivered for North and South Asia as well. And on balance, we actually did see a slight deterioration. So that sort of tracks what we'd seen from other economies in the region as well, Heidi.
Yeah, we are just getting some data coming through from Australia as well. These are building approvals. Month on month, we're seeing actually a contraction of 1%. Very interesting, given the survey landed at about a 4% gain. It certainly narrows a contraction of 9.5% that we saw in December, but January's reading still seeing contractionary territory at a time what we're seeing home prices continuing to accelerate in Australia, extending gains even in the sort of environment of very elevated interest rates. We have seen, of course, population growth spiking, new housing construction continuing to slow down, and that is really what we're seeing in those building approvals. Private sector houses also seeing a fall of about 0.5% there as well. And in fact, if you take a look at the December numbers for building approvals, it was actually revised lower to over 10%. So potentially this supply situation is going to create even more of a momentum play when it comes to home prices in Australia. This is what we're watching when it comes to broader trading, though, and of course it is all about Japan today as we see that advance over that 40,000 level for the first time. It really didn't take us very long to get there when we were starting to sort of eye that gauge sort of in this latter half of last week. But this potentially opens the door to further gains in what has really been a historic rally here. Tech in particular, chip making producers, as well as some of those AI adjacent names have really been helping those those gains over the past year and still some of the best performers in this session as well. The broader Topex index also advancing, but that is still about 6% below its record high. That is from more than 3 decades ago, before the asset bubble bursting in Japan. So we have some ways to go before we get there yet. But take a look at some of the outperformers that we see in the session. Hynix there, Samsung Electronics in Korea. And of course, we are watching Korean stocks as well as it tries to really replicate the governance reforms that have really finally begin to pay off in Japan. Investors will be very cautious going into the start of trading in Greater China as well, given it is a big week. CPPCC and NPC global markets watching for any kind of policy delivery, fresh policy direction for the Chinese economy, which is continuing to face property market turmoil, weak consumer confidence, persistent deflationary pressures, and of course the overlay of geopolitical tensions. Bloomberg's chief North Asia correspondent Stephen Engel outlining the priorities at this year's 2 sessions.
Early spring's cross-currents in Beijing can be tough to read as China faces a host of economic headwinds ahead of the annual session of Parliament, the National People's Congress. With property market turmoil, poor consumer confidence, persistent deflation, destabilized geopolitical ties, along with plummeting FDI, and a rocky stock market, simply put, it's not been a good first year for President Xi Jinping since taking a precedent-busting 3rd consecutive term last March.
The economy is still slowly recovering, but I think the confidence has not come back.
So far, state-directed funds have mobilized to stabilize wobbly markets, while Beijing replaced the head of the securities regulator and cracked down on so-called malicious short selling. Banks, too, eased a loan prime rate tied to mortgages, and consumers came back and spent mightily. During the week-long Lunar New Year holiday, the best set of Spring Festival numbers since pre-COVID. But was it all enough to turn the winter bears into spring bulls?
2023 has been an unfortunate confluence in China of deflation and de-risking. I think this year the policymakers want to go back into reflation and hopefully reform.
In terms of the ability of these measures to really change the market sentiment, we are slightly more cautious because what's really needed is a change in the inflation outlook for the country and the overall sentiment in the private sector.
You've got sentiment which is rock bottom, and at the same time, I think the issues of policy credibility in the market.
The growth engine remains one where it's more, let's say, government-led, infrastructure-led, manufacturing and investment-led, and those might help to get to the growth target. But in terms of the more dynamism and the more sustainable type of growth, we think it still needs some work.
So the attention now, as we're here in Beijing, turns to Premier Li Qiang's work report on day 1 of the National People's Congress.
Instead of looking for more candies from the government, we really want to say, can we actually go back to more like what China started in its reform back in early 1980s? Is more, allow the private enterprises, entrepreneurs to the right incentive to really to do things, the freedom.
Wishful thinking, perhaps, for global investors who got burned by multiple stresses on China's private sector, including COVID-0 and a regulatory takedown of big tech.
We've been out of China for a long time. We essentially started getting nervous about China when Jack Ma was hauled in. So that was in 2020, very long time ago. And for the past year and a half or 2, we've had no exposure to China, none whatsoever.
The world is watching Beijing's next policy move, perhaps at the NPC, with great interest. Stephen Engel, Bloomberg News, Beijing.
Let's bring Neil Thomas, who's a fellow with the Centre for China Analysis at the Asia Society Policy Institute. Neil, always great to have you with us. Was it Li Keqiang who said that these structural reforms could be painful, right? Like taking a knife to one's own flesh. Are we to believe that a painful structural slowdown is what China needs ultimately?
It's a great question, because I think it's clear from what Xi Jinping, the overall leader, is doing is that he recognizes that China needs to change its growth model. The Chinese government itself that started this property wobble of the last few years through its 3 red lines policy, they know there's too much of the economy focused on property, focused on highly leveraged debt activities. And he's trying to change that, but it's a slow road. And the danger is that you blow up the broader economy, the financial market, overall confidence while you're trying to do that. And of course, there's a big question about, can the policies that she's being putting forward, can they actually solve these problems? Because investors, the private sector have been burned by sudden, unpredictable, and frankly unfriendly policies over the last few years.
It wouldn't take much for that blow up, right? Because sentiment is just so horrible right now. So how careful do they have to balance the GDP target issue? I mean, around 5% is consensus. If they set it too high, they could miss it. And they also have to follow it up with fiscal support, so which doesn't ultimately, as you say, play into the kind of longer term goals. So what's the best approach here?
Another great question. I think, 5% is the consensus. It's the same as last year, but if that is what is announced, that would be a more ambitious target than last year, given that 2023 was a recovery year after the quite very poor performance of the economy in 2022 at the height of the COVID lockdowns. So that does suggest if it's 5%, there will be a bit of a bump to fiscal stimulus, maybe some slight monetary easing as well. But if it's a more ambitious target, if it is 5.5%, that would be hard to meet, but it would suggest somewhat of a change in thinking in terms of how much stimulus the central government's willing to tolerate compared to its drive to simultaneously reduce debts. So that would be a positive sign for at least short-term growth. But also if there's the possibility of a lower target around 4.5%, then that suggests that keeping this long-term debt situation under control and advancing other regulatory priorities is going to be more of a theme in what will be a more belt-tightening year than expected.
Given the base effects that are in play here, which does make any GDP target, even at 4.5%, perhaps really difficult to meet as well, because the assessment so far is that they're going to avoid any sort of bazooka-style stimulus. Do you think social instability is something we're going to be discussing a lot more over the coming 12 months?
I think the potential for more social instability is certainly increasing, but I also think that, like the years and decades past, we can't underestimate the effectiveness of China's security state. It's something that is a high priority for the regime leadership, especially under the Xi Jinping era. And, the security services, the Ministry of Public Security and State Security, they are also getting better and better at what they do. And they're learning how to use new technologies, like the internet, but also, artificial intelligence to improve their techniques for both suppressing but also resolving social tensions. So I don't think we're likely to see a huge national, international news type level of social instability. It'll certainly become more of a headache for President Xi to manage.
When you talk about tension, of course, there's always the cross-strait tensions there. What are we likely to hear around Taiwan independence, do you think?
So the two sessions and the government work report that the Premier delivers is usually not a setting to announce any new policies on Taiwan or even foreign policy more broadly. That's kind of more the business of the Communist Party and Xi Jinping, who leads foreign policy. But there is always a few lines on these issues. And I think a watch point for this is whether Premier Li Qiang repeats what Wang Huning, who's the top Taiwan official, said at a recent Taiwan policy conference about fighting rather than just curbing or opposing so-called Taiwan independence, to use the party's own language. And that wording of fighting, this would be the highest level that it would have been presented in any kind of party state official context, which could signal a toughening of the coercive and intimidatory measures that Beijing is willing to use to try and ensure that the incoming Taiwanese president, Lai Ching-te, doesn't go beyond where Beijing sees the status quo to be.
How much bandwidth is there for Xi Jinping when it comes to geopolitical hawkishness, given the economy is clearly a key priority domestically? And how much does that also depend on what we see from the US in terms of whether they continue supporting Ukraine, for example, on who wins the November election, on what Beijing's next moves towards Taiwan might be?
I think for this year, Chinese foreign policy is very much in a wait-and-see mode. They certainly will lash out and react if Lai Ching-te goes beyond the current situation in cross-strait relations in terms of the policies that his predecessor, Tsai Ing-wen, has laid out before. I mean, Taiwan is the core of the core for the Communist Party, as they would put it. But in terms of the broader foreign policy settings, and especially if that doesn't happen in Taiwan, then the focus is on waiting and seeing until what happens in November in the United States. Because right now we're in a moment of stabilization in US-China relations, and that helps Beijing to have a bit of a breather on the pace of US economic controls vis-a-vis trade and investment and technology in the US-China relation, and helps to create a more positive atmosphere in general for foreign investment and domestic investment in China. So I think Xi and Li Qiang and the top leadership want to keep that going for at least this year, and then see what happens in November, and then, if needed, readjust to a new administration.
That was Neil Thomas, Fellow of Chinese Politics for the Center for China Analysis at Asia Society's Policy Institute. And the hottest weekend getaway destination for Hong Kongers has become Shenzhen, the Chinese city just across the border. Big box retailers Costco and Sam's Club have been a particular draw card. And many young people who once protested against Beijing's influence over Hong Kong are now heading to the mainland for cheaper dining and entertainment. Let's get more now with our China economy government editor, Alan Wong, joining us. And yeah, it's quite an incredible reversal or change when you think about the protests that started in 2019. What is it behind this sort of cross-border lifestyle that we're seeing?
We're seeing a record number of Hong Kongers crossing the border on weekends and holidays, so much so that some Hong Kong bars and restaurants complain that they used to look forward to weekends and now they dread it because their bars are now empty and restaurant bookings are down. It's happening partly because for a number of Hong Kongers who crossed the border, they used to protest China's integration of Hong Kong, their influence on Hong Kong's politics. And now they're not exactly embracing it. They've just have this profound sense of apathy and indifference after the crackdown on security in Hong Kong that, in their view, eliminated all hopes of reform. So they told us that they might as well go across the border to seek bargains, like many other Hong Kongers. And obviously, Shenzhen has always been cheaper than Hong Kong. There's always been great deals across the border. But it has become more appealing because, first of all, Shenzhen has developed and become more prosperous, and a lot of its shopping options have diversified. And also, all the boom of infrastructure in the previous 10 years is paying off, because going to Shenzhen now takes only 20 to 30 minutes. It used to be an hour-long trip that requires taking the train and then maybe the ferry and maybe other connection transportations.
In what ways does this matter? Because obviously there are negative implications for Hong Kong.
Yeah, one economist estimate that Hong Kongers in Shenzhen are spending up to $84 billion on retail and services, and that is about 15% of money they didn't spend in Hong Kong. Restaurants and bars, they don't like this for sure, and then there's some local politicians and economists suggesting imposing a departures tax on Hong Kong residents leaving the city just to protect the local economy. And this has also been an urgent call to the local leaders to think about how to better attract tourists, because as Hong Kong tourism to Shenzhen and the rest of China hit record highs, the reverse hasn't been true. We're seeing that the travel numbers from mainland China to Hong Kong is still below the 2019 level before the COVID isolation.
All right, our China economy government editor Alan Wong joining us, and you can get an insider's guide to the money and people shaking up the finance hub in our new Hong Kong edition newsletter out every Thursday. You can sign up via Bloomberg.com/newsletters. We'll have plenty more to come on Daybreak Asia. This is Bloomberg. The resilience of Asian demand for luxury brands will be in focus this week as Prada reports its fourth quarter earnings. Let's get more now from our breaking news earnings specialist, Harshita Swaminathan. And Harshita, I mean, big focus really on Prada, Hong Kong listed, what it's going to tell us about demand, especially from mainland China.
So Prada is expected to report earnings on Thursday, and we're expecting about a 40% profit growth for the year. Bulk of this is, of course, coming from Asia, as it has been in recent times, just because of some wealth creation going on in the region, and with that comes a whole new class of people that are able to spend on things like luxury handbags from Prada. But one interesting thing that we're seeing is that a lot of the demand is coming specifically from Japan. There's a couple of reasons for this. One, of course, is that there is very good underlying demand from a region like Japan, but also because of the weaker yen, that's made it cheaper for a lot of tourists to buy luxury goods from Japan as opposed to Europe. Rather, the price differential between buying stuff from Europe versus buying luxury from Japan is really narrowed, and that's something that reflected in other luxury houses' earnings as well. Like when Hermes or LVMH reported, Japan was their fastest growing region that they reported, and that's something we expect will play out with Prada as well.
Do we take sort of broader signals from the performance out of Prada when it comes to consumption trends across Asia and what we're seeing across those demographics?
Well, Prada is, of course, a luxury brand, so it's not fair to really extrapolate that to broader Asia, but we are seeing a fair bit of divergence this time around. For instance, JD.com is also expected to report earnings later this week, and it's expected to report its slowest revenue growth in about a decade, if not longer than that. And the reason for that is its pretty heavy exposure to China, and as you earlier spoke about in the show, there's been a lot of economic troubles going on there, and one of the side effects, of course, is the dampened consumer sentiment because of that. So we're seeing a pretty sharp divergence between how luxury retail has been performing versus how the more mass market retail is expected to perform.
Our breaking news earnings specialist, Harshita Swaminathan there. More ahead here on Daybreak Asia. This is Bloomberg.
All right, big milestone on Bloomberg television this morning. Just in about 7 minutes from now, we're going to have a new show that's starting here today. This is the very first edition of the China Show with Yvonne Mann and David Ingles. But Yvonne's here now. So, Yvonne, I mean, yeah, as we said, new show, but also what a week to start as well with the MPC opening.
It's a crucial week, so why not launch on the week of MPC, right? I think it's interesting because David and I, along with Tom McKenzie back in 2019, when we first launched the China Open, I still remember those days and how exciting it was. And we're still building up to that momentum still with this new show. And we're going bigger, and we're going to be that better, too, because we're going for full 2 hours now. And it just gives us a chance to really breathe and let the stories that we talk about really kind of let people digest and kind of look at more deeper dive into a lot of big conversations that we talk about. So it's not just the news of the day that we're going to target. It's going to be about parsing through local media, the statements that come through, what's trending on Weibo and the like. So it gives us a chance to really talk about some of the deeper issues here in China and really kind of, MPC and beyond, Heidi.
Well, I mean, get that pulse check as well.
Yeah.
And Yvonne, you know how excited I am when it comes to more things on all things China, right? But, arguably there's no more critical time than now to be spending more time getting this analysis, to be able to try and come up with some of the answers to the big questions. The economy is slowing. It's a structural slowdown. What does, what does this mean for investors in China in the long term, right? The geopolitical tensions as we get into potentially a different US presidency and all of those things that get thrown up.
Yeah, there's a lot, right? And I think we're going to have some really key newsmakers today and throughout the week to kind of get through all of those themes, as you mentioned. It's not just the macro. It's also some of the domestic kind of concerns that we're dealing with as well. The U.S.-China relations, as you talk about, as we count down to that U.S. election in November. So we got a big lineup. Even just today, kicking things off with us is George Sun joining us from PNB Paribas, really just to talk us through what's really going to be the sentiment leading up to the MPC. And then we have the best of the best when it comes to China equity strategy. strategy. You got Kinger Lau from Goldman Sachs, Winnie Wu of BofA Securities here. They have slightly different views on this China equity market as well. So it'll be interesting to put those two together to kind of talk through, of course, what's to come this year. Amy.
All right, the China Show airing every weekday with Yvonne and David. And as we said, that show launching just at the top of the next hour. That's it for this hour of Bloomberg Daybreak Asia. That new show airing just ahead.